Okay, hello everyone. This is Miltos Savvidis doing my weekly trading roadmap for the week starting the 16th of February 2015. It's quite late at night, had quite a busy weekend, so I'm going to try and get through this as quickly as possible so you guys can have this by Monday morning. So, to start off with, starting on Monday, we have US holiday, so it's President's Day. We are going to be expecting a lot less volume. CME is going to be pretty much closed for the pits on the equity and the fixed income indices. But what you should be noting is since we have all this discussion out of Greece coming out, we could get comments overly extending and getting some, overextensions in the market if there's actually any fundamental change in the market's perception of risks. So just keep that in mind, bear that in mind going forward because that's going to be quite interesting, to know if we do actually get some big things coming out. We could see some overextension just because of the light volume. So, starting with Greece, we have the Eurogroup meeting, which kind of starts at 2 o'clock. Up until then, for those of you that are thinking of coming in late, I would probably refrain from doing so. We could get comments or rumors or anything of the sort up until that time. So, really you want to be in, I think, as early as possible, just in case we get anything. Effectively, this Eurogroup meeting is, they're doing some technical talks, Greece and its creditors for an extension of the current program. Now, this bridge program that Greece wants is basically just a rebranding of a bailout. Obviously, Greece, with its new party Syriza in power, which basically got elected on not going for a bailout extension. I mean, if they just rebrand it as a bridge finance with certain amendments, that could maybe fly in the face of its the voters. And it seems like that's really the likelihood of where this could be going. The Eurozone obviously wants to keep its tougher structural reforms, but the important thing is if we actually get a failure of any sort of agreement tomorrow. Because I think even if we get an agreement, it doesn't really mean that everything's been resolved, but rather it's just a first step in a really longer process. They have to put in the framework of how they're going to put into place the structural reforms, the fiscal policies, and such. So really, that's not. It's just a first step. Nothing's been absolutely resolved, but the market does want to be hearing good news at the moment, as it's shown. So if there is some sort of failure to an agreement or there's still a major deadlock, that'll push most of the attention to the February 18th ECB review of the ELA limits or the emergency liquidity assistance for the Greek banks. The Greek banks basically surviving because of this emergency liquidity that the ECB is offering. So if there is such a failure, we will be focusing more on the February 18th if the ECB actually says something there. We'll go through that in a little bit. Looking at some of the market structures that are of relevance, I go through the Eurostoxx quite often, and we'll just bring that into focus here. This is actually a monthly chart of the Eurostoxx going back all the way, as you can see, to 2000, where it made its all-time high. Up in here, you can't actually see it, but that's where it made its all-time high. We're currently challenging this. Well, we're not even close to that yet, but we're currently moving towards this recent swing high. What I really want to bring into focus here is that we've had this move outside of this consolidation here, as you can see. We've posted a green month last month above that, and we've subsequently made a move towards this area. Now, this area, I think, is pretty much very crucial. You can see here we've had a couple of swing lows and swing highs. Every time we've come into this area, I mean, we have seen some reactions in a longer time frame market structure. So what's kind of key for me, and we're currently sitting in that area right at the minute, where we closed on Friday. We're in that region of 40 to 50 ticks. So what's important for me is if we take a look real quick at the market profile, I'll just zoom that out there, we can see that Friday we had a very, very lackluster volumes across all markets, and especially in the Eurostoxx. After breaking this pretty key area here, these 34.30s, if I'm not mistaken, just above here. You would have been expecting a little bit more of some fresh longs, some more volume, and some initiative buying in this area, which we didn't really see. It seemed like we got up here, we just got a bit comfortable and found some value. Now, why I'm pointing this out is obviously I'm not saying by all means to be fading this market, but I'm trying to point out something to be wary of. Um, Obviously, we're in a very technically and fundamentally bullish um, structures, and the underlying sentiment is very, very bullish. So the context is bullish. But having said that, what I want to point out is that we did a lot of low volume, uh, well, just basically low volume on Friday, and we found a little bit of volume of value in here. But I wouldn't be surprised, being as we're in that area of support and resistance on a longer time frame, I wouldn't be surprised if we did actually just challenge this high and then poke ourselves back inside this week's or last week's value area, and then kind of slowly make our way down, or maybe even aggressively. You just don't know. Being as there is a few risks on the table, and we have seen this bit, this puncture of the high with just not enough volume for my liking. If we do actually start selling off, I would be looking at these areas pretty keenly. We've got a big TPO gap in here with some low volume that could be easily filled out. Whether we sit above here is be quite important, above these highs here. If we do start dipping back inside, I think it's quite fair to assume that once we start trading in here and have having a bit of an offer, we could get this just filling out this very large TPO gap in here. Also very important to know, obviously, on first test we have an extremely low volume node. I think something like 2,500 contracts or maybe even less at 3404. So just keep that in mind. But if we do re-enter this is basically the value area of 2 weeks ago, right in here. A key area for me, obviously, being these 3387s and 3382s. Just this area in here, we've seen a pretty nice little decision zone, an inflection point in the market. It's shown us evidence that it's paying attention to this. So I would be looking at this quite keenly if we do get back down here. Now, on a bullish perspective, obviously, you want to see this market hold above these highs. That's pretty plain and simple, I think. If we do start filling this out, but we can't actually offer below this, then obviously there is scope for this to just continue higher. But with the current market structure, you wouldn't want it to just, find its way and nestle its way in here, get too comfortable underneath Friday's value. You actually want to see it start building higher and higher value areas. So that's quite important, I think, quite key to note coming into this week. If we do just all of a sudden, because it's a low volume Monday, we just start seeing an offer that we're not really expecting, and possibly on some catalyst, some Greek news, if we do start getting offer down, just don't be surprised if some of the levels you're expecting to hold are not holding, given the the structure. Obviously, in a weekly and a daily structure, we're very bullish, but mind you, on a longer time frame, there is an inflection point that we've come into. So if we do see sellers coming in here for whatever reason, just bear that in mind. So looking at the Bund very, very quickly, the Bund futures, I think the Bund has started to tell its hand for the short to medium term. We saw a bit of bearish price action come in over the last week or so. However, I think as it stands, we've built in a very nice price base in here. Now, at the all-time high, just below these 159.54s, down to these 159.18s, that for me is a little value area, just above this price base or value area that we've been trading in for pretty much 2 weeks. So about 3 or 4 days ago, we poked our head just outside these 158.32s. We had this 3 TPO ledge. A lot of people were looking at it quite keenly. We just flushed through and then bid right back up. Actually, there was quite a few squeezes in this. It was really nasty. But nevertheless, we left the buying tail. And as it stands, we've got an inside day left on Friday. So the way it stands, we've kind of rounding this off. I don't want to call for any sort of cup and handle at the minute, but this is showing trademark clues or indications that it could be forming something like that. We have the lip at the top, a base in here. So if we do build another little lip just in here, maybe spike up to the top and then sell off a little bit and then eventually go, well, I mean, it has the, the hallmark um, clues of that already built in. Nevertheless, this is a price base. If we do, find a bit above here, this is going to be, your base. You're going to be looking, at the inflections around these 159.18s and just above that right here. So just bear that in mind. That's the current structure in the Bund. That's kind of what it's been showing us as of recently. Tuesday data points. We've got UK CPI. Could be pretty volatile. We could see some market moves on that. The previous reading was at 0.5%. We got the German ZU as well. Not expecting any major moves on that. That's been a relatively good fade as of recently. And plus, we have already had our central bank stimulus out of the ECB. So I think the market's not really leaning on these kind of figures right now. From a central bank policy perspective, we've got the Fed's Plus are talking. And just to look at some of the market structures of relevance to the UK CPI in actually we can see in here what's important to know is that we saw this really aggressive bounce from about 133s all the way up in here, and we've closed at around 167.8 on the yield. What's important for me is that obviously the structure and the context of the market over the past you could say pretty much year has been to the downside in yield, so to the upside in price. We have actually seen a lot of what it seems like hawkish bets. You can only say they're bets because effectively they'd be taking short positions on the futures. The market's moved very aggressively to the upside in yield. I would say though we haven't particularly closed above this 169.4 yield just in here. We actually closed just below that. So the context is still to the downside. If we do see a fresh bout of longs or some passive buying in the market, don't be too surprised. If we do get a lower reading in the CPI. On the contrary, we have seen some initiative by selling in the gilts. So any sort of higher CPI numbers are going to provide some further catalyst for moves in the yield to the upside. Wednesday's data points. Wednesday being quite a very busy day actually. From the data point perspective, we've got UK ILO unemployment 3-month and the UK average hourly earnings. On the central bank front, we start off really early in the morning, 2 or 3 in the morning. We've got the BOJ's policy statement. There's no actual expectations for further QE or a rhetoric on further QE. What's important really to know is that we've had some sources comment on BOJ officials they're growing more and more concerned with the effects of weaker yen on the Japanese economy. But what is even more important to know is that we actually haven't had any confirmation or decline of this comment. So as it stands, we've had a lot of central banks taking action at the beginning of this year, and Japan is actually the aggressor in this whole global currency war that we're seeing. I mean, it's not really talked about that much. You get a few articles here and there, but I mean, realistically, it's still, the currency wars are still there, and Japan has been in the past decade, the aggressor. Now, it wouldn't be surprising for me if they actually decline some of that rhetoric or even do more stimulus, which is something no one's really expecting. Now, what's important, and before I move on to some of the other things, if we take a look really quickly at the US dollar yen, as you can see, we had a bit of consolidation. 2 weeks ago, we had these 2 inside weeks. We had the break to the upside, but last week actually closed fairly weak, closing back inside this structure. So as it stands, the structure of this market is looking actually quite bearish. But having said that, if we do get any surprises out of the BOJ with any stimulus or a decline of those kind of comments, we could see this bid right back up very, very quickly. On the contrary, again, to that, if we do see some confirmation to that, we're at a really key inflection point. We could see this just really vacuum its way and make its way to the other side of the structure. So bear that in mind. This is obviously being a very key risk barometer in most equity markets as well, especially the S&P. Now, going back up again, with regards to Greece, we're seeing the ECB's ELA review, which, as we said previously, if we do get no agreement tomorrow on Monday, um, we could actually see the ECB give the market a timeline on a potential ELA cap or, or withdrawal altogether. Now, if they actually do that, they're really going to be clamping down and putting a vice around Greece at that point in time. And they've done this before. They've done it with Ireland and they've done it with Cyprus. So it's something that they're capable of doing. I wouldn't expect it, expect the ECB to really put their nose in these political issues. However, it's something they can do. They can kind of force the issue and put some more pressure on Greece, which would inevitably cause a bit of uncertainty. So definitely something to be keeping your eye on if we do actually get a bit of disagreement on Monday. If we don't, maybe the ECB will just be, a bit more understanding and extend their ELAs and not really see any market action other than that. But definitely something to keep your eye on. We've also got the BOE Minutes on Wednesday. There's no particular market expectations around that. However, if we do see a bit of a reversion back to these 8-1 or 7-2 votes, with regards to rate hikes, so if we get one vote in favor of rate cut or two vote back to the 7-2 that we've seen over the past 5 months, well, that would be a surprise, and we could see some fresh hawkish bets on the table. Although, again, just want to note that is highly unlikely. We are actually expecting short term the BOE to stay quite dovish. On their longer term, as we've seen on their QIR, they're actually slightly more hawkish, expecting an overshoot of inflation. But again, if we do see something in the short term again, which shows some hawkishness, we could see some pretty nice moves. If we take a look at the market structures with relevance to that, we saw last week with the BOE's QIR a very nice bid in the pound dollar. We went through this market structure saying how we were just, uh, building this inverse head and shoulders just below a larger time frame trend line, which I showed you guys on a weekly structure. I won't pick that up again, but you can take a look at my my video from last week where I go through that. However, what's important now is obviously we're in the midst of completing this pattern. So the completion of this pattern, obviously we talked about how it's about 320 pips from the break. That'll comfortably put us around 155. So I don't really see, if we don't actually get anything changing out of the BOE, or if the data that we get, the CPIs and the employment numbers don't actually change anything, then this really should continue technically to finish its pattern. On the contrary, if we do see some changing, possibly worse numbers on inflation, worse job numbers, well, yeah, we could see a sell-off. I would always lean towards the technicals because this seems like a fairly, bullish structure to me. So if we do actually get some worse numbers on inflation, and we get some selling in the GBP, I would actually use that as a very nice way to get long this. But on the contrary, you do want to be looking at the BOE. If they do actually come out and have this change this vote structure, we could see just a really quick move up, and this target will be met very, very, very quickly. Looking just right back up again, the last thing on Wednesday, obviously I've said it's a huge, very busy day. We have the FOMC minutes. So really what we're looking at is any possible clues for forward guidance and the committee's view on the removal of the word patient. Obviously this word basically meaning, if they remove this, they're looking at hiking rates in the next, not the next 2 months, but after 2 months. So as it stands, they left it in the last one, so we're still looking at around June now. If they keep it in the March one, it doesn't mean June's out of the question, but still, we're still looking, at 2 meetings after that. So if there was any serious discussion around removing it this time, that could actually fuel the fire for further sell-off in the U.S. curve and strengthen the dollar. We saw some really big bets coming in after the jobs number 2 weeks ago. So the NFP came in quite big. We had some big revisions. But most importantly, we saw a big move in the average hourly earnings. So they was expected at, I think, 0.2%. It came in at 0.5%. Um, so we've had some fresh bets on the hawkish side, which is quite important. If we do see any serious discussion around that, maybe this will just spark it to move even further in that direction. However, on the contrary, I will put forth an argument. If we see any possible rhetoric around the international developments language, which you saw in the January statement, that could send a dovish signal that the market's not really prepared for and catch some of these current hawkish bets off guard. We get some really quick short covering. Uh, Now, what's important to know is the Fed Chair Yellen's semi-annual testimony to the Congress is on the 24th and 25th of February, and that could really provide more color. So maybe we don't get much out of these minutes, but this is probably what the market's going to be more focused on with regards to language. Taking a look at a market structure, and I think it's quite interesting to look at this. Again, very similar arguments to the 10-year gilt market. The structure obviously being bearish on yield and bullish in price. So we have seen in previous times we've saw these very big bounces. The market's inevitably just rolled over as the inflation outlook just stays very, very subdued. So really, as it stands, and what's quite important, if we do actually get anything dovish, something even minorly dovish, maybe we could actually see a market kind of roll over or push its way down. Another, argument for that. Actually, before I go into that argument, I'll just put the argument forth that we have seen some initiative selling in price. So if we do actually see this patient language come out, or some strong signaling towards removing the patient language, well, then we could see this really move very quickly to the upside. Now, back to my argument about how this yield could actually come back down. What's important to note is if we take a look very quickly, I'll just put this chart up for you guys to take a look at. Now, as day traders, or outright day traders, we don't necessarily look at these charts very often, but I tend to look at them just to give me a bearing on where the market stands, because usually we get some pretty clean moves if the spreads start moving in unison with the outrights. Now if we take a look at the Bund, the Tnote Bund yield spread, going back all the way to 1999, you can see we made this high at 169.1 in yield differential. So that was our high previously. Now we made basically our recent high at 167.20 last week, and that was also a high that we had, I think, just in the beginning of the year or just before 2015 started. Now what's important to know is that on a cyclical basis, this is the highest this yield differential has been pretty much in the past 15 years. I don't have the chart going back even further than that, but that seems pretty logical to be, the high point or an all-time high, in fact. Now what's important to know is that this spread is obviously widening as the T-note sells off and the Bund stays high. And we've seen on various occasions the Bund holding its bid, which I showed you previously, holding its bid, showing that it wants to stay bid, this spread just widening, and then eventually once this spread starts making a move back down, which we saw a few times in the past, in 2014, from the beginning, or actually mid 2014 towards the end, we saw this spread kind of move very, very quickly in the opposite direction. That's where you see these passive buying cup and handle formations in the Bund actually just explode to the upside because the Tnote finally, comes back down. So if we do see some fresh bets in this, basically uh, long the Tnote, short the Bund. In any case, maybe this week or the next week, just keep that in mind. There is an argument on a value basis for that to take place. So just bear that in mind going forward. It could be quite important. On the contrary, obviously, if we do break this and continue higher, maybe the market just wants to seek new value higher. You can never say never really, but that is really your key point, 169.1, to be looking at in the short term. Looking at Thursday, we have the DOE crude oil inventories from a central bank policy perspective with the ECB minutes. Really the only thing to be looking at, because we really don't know the structure or how they're going to be, or what they're really going to be releasing. I think the important thing to know is, well, are they going to be showing their votes, or are they not going to be showing their votes, like the BOE, for example. This could in the future, maybe not for this time, we've had a recent stimulus, but for the future it could make a difference for us traders on event-driven risks, on further QE decisions or anything of the sort. It's going to be quite important to see if they have votes. I think votes would actually be something very clear, cut, and straightforward to trade. So I think that would be great from an intraday trading perspective. Market structure, obviously, we got the DOE crude oil inventories. It's not the hugest number to be paying attention to, but obviously we have some market structure that's building in the WTI crude oil market. What's important to note is that we're currently, in my opinion, I mean it's a little bit sloppy, but we do have this bit of an inverse head and shoulders building, which goes back to the beginning of December 2014. What's really important to know is that we had this kind of small attack of these lows at 44.20, which we did on very lackluster volume, as you can see in here. And then we had this bid up on pretty high volume, and really we actually done quite a bit of volume, relative to what we've been doing going back. We've done a lot of volume in here, which is quite important for me, because we're slowly building lower highs and higher lows at the same time, which means this is a coil. This is currently building a lot of energy. Now, whether this is an inverse head and shoulders or not, it doesn't really matter, because if we do start breaking higher above this area, well then, if there has been some shorts in this market, it could be a very, key time to get those shorts start squeezing to the upside. Now, on the contrary, obviously, if we do get a break to the downside, we could also see a continuation. You remember the context of this is firmly bearish, and by no means is this bullish. But if we do see a break over here this week, possibly, whatever news, then we could see some fresh moves to the upside. Looking at Friday, nothing much except for the equity and bond OPEX, so the options expiry. And we've got data points out of Europe, the PMI and PMI manufacturing and services, and the UK retail sales. From a risk and money management plan perspective, so this is how I've set it up for this week. We only really have one event-driven risk for each day, apart from Wednesday, with their relevance accordingly. And as you can see, obviously, Wednesday was the busiest day with the highest relevance. So I put in a 35% risk allocation around that. And I must have made actually a bit of a mistake here. Thursday, I put in 20, but it should be, I think, slightly less for Thursday. But you want to be putting a little bit more risk allocation towards Monday. So whatever, if you take, let's say, 5 or 10% out of here, I'd add it to Monday. Because Monday is actually, I mean, even though it's low volume, we could see some comments, we could see some things out of Greece that could be moving the market. And Friday, obviously, we've got not much data, but we do have OPEX, left a little bit of risk allocation for that. Again, very important to know, I say this every week, this is what theoretically I would be using as my risk and money management plan. This will change almost certainly for every trader. This is just a guideline. This is something that maybe you can take a look at and maybe move the way you manage your risk and money around your edges, because it's really important to manage your money around what makes you money. Okay, so that was my weekly trading roadmap, a little bit longer than I've done previous ones, but I hope you guys use it and I hope you guys can profit from it. Happy trading for the rest of the week, and I will speak to you again on Friday with my weekly trading wrap up. Thank you very much.